Welcome to the Deep Dive. Today we are cutting through the noise, getting right into the Five Below earnings call. That's for Q3 fiscal 25, and it dropped right after the market closed on December 3rd.
Yep, and our mission today is to really unpack what might be the most aggressive earnings beat we've seen in specialty retail this quarter.
Right.
We need to decode the new leadership's vision, look at that big guidance raise, and just figure out why this retailer seems to be defying gravity.
And the market was already feeling pretty good about them, right? The stock was up almost 2.7% before the numbers even came out.
It was. But what they delivered, it wasn't just good. It was staggering.
Okay, so let's start at the bottom line then. What was the headline number that made everyone do a double take?
It was the scale of the surprise. So adjusted diluted earnings per share, or EPS, came in at a remarkable 68 cents.
68, and the consensus was what?
The street was huddled around 22 or 23 cents.
Wow.
That's a surprise of around 200%. A 62% jump over last year. It's just massive.
A beat that big, you usually think, okay, maybe it's a one-time thing, or they had to sacrifice revenue to get there. But that wasn't what happened here, was it?
Not at all.
Yeah.
That's the thing. Revenue was also incredibly strong. It came in at $1.038 billion.
Over $1 billion.
Yeah, blowing past the highest street estimates by, somewhere between $50 and $70 million. I mean, that's 23% year-over-year growth.
So Five Below is officially a $1 billion a quarter retailer now.
For the second quarter in a row, yep. They've crossed that threshold.
But the real health metric for a retailer like this, it's always comparable sales. How's the traffic? What did the comps look like?
Exceptional. Just exceptional. They hit 14.3% year over year.
14.3.
And management was really clear to point out, this wasn't just one thing. It wasn't just price hikes. That surge was perfectly balanced.
How so?
It came equally from increases in comparable transactions. So literally more people walking in the door, and from increases in the comparable ticket size.
So more shoppers, and those shoppers are spending more money. That's the flywheel.
That is the absolute definition of the flywheel.
So you have this huge transaction increase, a huge ticket increase. It leads to a massive comp, which then just explodes the margins. But the after-hours reaction was, I'd say, kind of modest, right?
It was. It drifted up maybe 2%. I think that just tells you investors were already expecting excellence. This call just reinforced the bull case that was already there. It didn't create a new one.
Okay, so let's unpack that. A 200% EPS surprise doesn't happen by accident. We need to dig into the execution, starting with those margins. That's where the real story is.
The leverage was just incredible. So gross profit grew about 36% year over year. But the number to watch is gross margin. It hit 33.8%.
And what's the expansion there?
That's a gain of about 320 to 330 basis points. For anyone listening, that's over 3 full percentage points of margin growth.
That's enormous for a retailer. What was the main lever they pulled to get that kind of efficiency?
It really came down to two things. First, just the fixed cost leverage. When you have a comp of 13.3%, your rent and other fixed costs just become a smaller slice of a much bigger pie.
Sure, that makes sense.
And second, they pointed to some early benefits from improved shrink mitigation. So they're getting a better handle on theft and loss.
And what about spending?
Very disciplined. SG&A selling, general, and admin costs was actually down 40 basis points as a percentage of sales. You put all that together, and your adjusted operating income grew 63%. The model is it's firing on all cylinders.
All right, let's talk strategy. The CEO, Winnie Park, she framed this quarter as proof that their customer-centric strategy is working. And this is with some new faces in the C-suite, too.
Yes, exactly.
Yeah.
They brought on a new CFO, Dan Sullivan, and a new CMO, Michelle Israel. And their messaging was all built around this three-pillar strategy.
Oh.
The first two pillars are really about focusing intensely on their core demographic, Gen Alpha, Gen Z, Millennials, and then creating that seamless journey from social media right into the store.
And this is where it gets really interesting because they didn't just spend more on marketing, they fundamentally changed how they market.
That's the key insight. They shifted spend from traditional channels into social, yes, but they also changed the content itself. They moved away from expensive, centralized studio-produced stuff.
And moved toward what?
Creator-produced content. We're talking influencers, user-generated content, things that feel more authentic. It's a double win, really.
How so?
Well, you get more authentic content that actually drives traffic from Gen Z, and you also lower your overall content creation costs. It frees up capital for other things, like opening new stores. It's just smarter.
It's a very smart move. Now, the third pillar, this value architecture revolution, feels like the biggest change to who they are. They integrated those higher price points, $7, $10, even $15, right into the main aisles.
This is a fundamental change to the floor plan. It's a change to the entire business algorithm. But they were very careful to stress that, about 80% of their stuff is still $5 and below.
So how did they do it?
They got rid of that separate 5 Beyond section. They just dismantled it. And they wove those higher price items right into their departments. Toys with toys, electronics with electronics.
Okay, I have to challenge this because this is what I'm thinking if I'm listening. Doesn't that risk diluting the brand? Isn't the whole point the $5 treasure hunt? Are they confusing the core customer?
That is the billion-dollar question and the one the street was asking. Management got way out ahead of it on the call. They said the customer response has been overwhelmingly positive.
Really?
Yeah. They claim it actually simplifies the shopping experience. It's less confusing. And a bonus is that the floor space, they freed up from that Beyond section. They immediately used it to expand their seasonal business, which is, critical for the holidays.
That makes a lot of sense. And all the while, the store growth engine is still running at full speed.
Absolutely. They opened 49 net new stores in Q3 alone. They're at over 1,900 stores now. And they specifically called out a successful entry into the Pacific Northwest, opening 8 new stores there. They still see a lot of runway for growth.
Let's pivot to the outlook. The new CFO, Dan Sullivan, he's the one who delivered the guidance. How strong was that raise for the all-important Q4?
It was very strong. It basically confirmed that this momentum is continuing. For Q4, they're guiding to net sales between $1.58 and $1.61 billion.
And the comps?
That implies comparable sales growth of 6 to 8%. And most importantly, they raised the full-year EPS guidance to a midpoint of $5.80. That's about 15% year-over-year growth. So no, they're not slowing down.
Now, we have to talk about the big risk that came up on the call. Inventory. Average inventory per store was up almost 25%. In this retail environment, that's usually a massive red flag.
It is. It usually screams bloated stock markdowns coming.
That wasn't the story they told.
No, they were very clear. This was not a demand problem. This was a strategic choice. They deliberately accelerated receipts.
To what end?
To get ahead of the, and I'm quoting, the global trade environment and potential tariff risk going into the holiday season. They basically made a bet to prioritize having the inventory on hand over worrying about geopolitical risk down the line.
Okay, so it's a strategic move. But what are the financial implications of that move, of pulling all that inventory forward?
And this is the key nuance for you, the listener, to really hang on to. Management cautioned that while they've been mitigating tariffs, some of those costs are already incurred and are now, quote, trapped in that inventory.
Trapped costs. Can you give us a quick analogy for what that means?
Sure. Think of it like this. You bought a ton of supplies at a higher price because you were worried tariffs would make them even more expensive later. Those supplies are now sitting in your warehouse. They don't hit your profit and loss statement, specifically your cost of goods sold, until you actually sell them next year. So the inventory they pulled into Q3 and Q4 this year will flow through their costs in the first half of next year.
So it'll make next year's margins look a little weaker than they actually are.
Exactly. It's an accounting headwind they're choosing to take on now to guarantee they have the stock for the holidays.
That's great clarity. So thinking about next year, analysts are always looking ahead. How did management handle the question of comping the comp? How do you beat a quarter this good next year?
They seemed highly confident. They pointed to 2 big tailwinds. First, they said traffic actually got stronger as Q3 ended and moved into November, so momentum is building, not peaking.
And the second tailwind?
The structural lift they're getting from those higher price points, the $7, $10, and $15 items. That benefit doesn't anniversary or become harder to beat until the second half of 2026. That gives them a kind of a built-in advantage for the first half of next year.
So if we connect all this to the bigger picture, that this company is a momentum darling. The stock's year-to-date return, 55%. It just crushes the S&P 500.
Absolutely demolishes it. The S&P is up just over 13%. The broader retail ETF is basically flat.
And that outperformance explains the valuation.
Exactly. That's why it trades at a premium. The stock has a trailing PE of about 33 times. The average analyst target is around $174.
So that valuation is telling you the market is already pricing in perfection. They expect high teens EPS growth to continue.
which is why a 200% earnings beat only resulted in a modest move. The market expected this. The story is aggressive store growth, productivity getting back to 2021 levels, and margin restoration.
The execution is phenomenal. But the risk is simple. Those expectations are incredibly high.
They demand this kind of performance every single quarter. There's no room for error.
All right, before we wrap up, it's time for the segment everyone waits for.
And let's be very clear. This is not financial advice. We are not telling you to buy, sell, or hold Five Below or any related securities. This is purely for educational purposes. It's an outrageous but plausible trade idea based on our analysis of this call.
Okay, so with that disclaimer front and center, based on the confidence we heard, that customer-centric flywheel you talked about, driven by smart marketing and that new price architecture, where could a long-term, high-conviction bet go?
Well, we see management playing offense. They're committed to 150 high-quality new stores a year. That new pricing is a permanent positive shift. But that 33 times PE means the stock could just chop around sideways for a bit, at least until the Q4 results prove they nailed the holidays.
So the idea is to leverage the long-term story while kind of neutralizing that near-term valuation risk.
Precisely. So the pitch is to initiate a long-dated, deep, out-of-the-money call spread. We're looking way out, maybe to a 2027 maturity.
Okay, break that down.
Specifically, you might sell a far out-of-the-money put option at a much lower strike. You use that cash to partially fund the purchase of a 2027 call option, maybe with a strike of $200.
So you're essentially betting that this new strategy, the better traffic and the higher ticket size, will push their productivity and store density so high that it blows past what the street is currently expecting over the next 18 months or so.
You're betting it pushes the share price well into the 200s. You're leveraging time, betting that this operational pivot isn't a fluke, but a fundamental improvement to the entire growth algorithm. It's a bet that requires patience.
And that concludes our deep dive into Five Below's spectacular third quarter. The core takeaway seems really clear. This operational shift, especially in pricing and digital marketing, has just fundamentally accelerated their flywheel.
It's a two-sided coin for you, the listener. You've got a company executing with incredible precision, riding powerful momentum. But that excellence comes with incredibly high expectations and an extremely rich price tag.
And we'll leave you with a final provocative thought to chew on. With the success of weaving in these $7, $10, and $15 items and their commitment to driving that average ticket higher, how long is it until the 5 and under items fall way below the 80% mark and they permanently change their entire business model, maybe even their name?
Thank you for joining us for this deep dive. We encourage you to engage with the material and keep learning. We'll catch you on the next call.